Okay, let's jump right into this explainer and pop the hood on a massive financial engine that honestly most of us never even think about. When we talk about money, we're usually focused on the stock market, our paychecks, or lately the price of groceries. But running quietly in the background is a system so colossal and so influential that if you don't understand it, you're missing the biggest piece of the financial puzzle. Today, we're focusing entirely on the hidden mechanics of bonds.
To really grasp the sheer scale of this hidden world, we have to look at the biggest borrower on Earth, the United States government. As of right now, the total national debt is sitting near $39.2 trillion. That number is just so large it almost loses its meaning, right? So consider this instead. The U.S. government pays $2.88 billion in interest every single day. And that is just the interest, not paying down the principal at all. That means the government is actually spending more on interest than it does on national defense. And every dollar of that interest is paid out of your taxes with the rate set by a market you probably rarely look at.
Which brings us to a question that hits a lot closer to home. When you buy a house, who actually decides what your mortgage rate is going to be? You might think it's your local bank manager or maybe the Federal Reserve. But actually, it's not your bank, and it's not the Fed. It is a $145 trillion invisible machine, the bond market, that quietly prices your mortgage, your car loan, your job security, and your retirement account. It literally touches every dollar in your financial life.
Let's start with Section 1, the Golden Rule of Bonds.
At its core, a bond is really just a piece of paper. It's a loan where a government or a company borrows money from investors instead of going to a bank. You hand over a fixed amount, your principal, and they promise you a fixed interest payment every year, plus your principal back on a specific maturity date. It's pretty straightforward. But there is one absolute golden rule you have to memorize. When interest rates rise, the price of existing bonds falls. They move in opposite directions every single time, without exception. Think about it. Let's say you buy a $1,000 bond paying 3%. You get $30 a year. But a few months later, new bonds are issued paying 5% or $50 a year. If you want to sell your old bond, well, nobody's going to pay you $1,000 for it when they could just buy a shiny new one that pays more. The only way you're selling that old bond is if you drop the price to about $600 so that your $30 payout mathematically equals a competitive 5% yield for the new buyer. You still get your $30 a year, sure, but on paper, your $1,000 investment just plummeted.
Moving right along to Section 2, pricing your real estate.
Of all the bonds in that massive $145 trillion market, the 10-year U.S. Treasury is the undisputed heavyweight champion. Let's see how this impacts a typical home buyer. We'll call him Brian. When Brian goes to the bank for a $400,000 mortgage, the bank looks at that risk-free 10-year Treasury yield. Let's say it's at 4.5%. The bank then tacks on roughly 2 percentage points to compensate for the risk of lending to a regular guy instead of the U.S. government. So Brian's rate is set at 6.52%. But look what happens if the bond market has just a routine trading week and yields bump up by a single percent. Brian's rate jumps to 7.52%. That tiny, invisible move in the bond market, it costs Brian an extra $269 a month. That adds up to nearly $97,000 over the life of his loan.
And when we look at historical extremes, it is just staggering. Take the exact same house and the exact same $400,000 loan amount. Look at the difference between buying in January 2021 versus October 2023. The monthly payment nearly doubled. The difference over a 30-year mortgage is an astonishing $455,349. The bond market literally handed homebuyers a $500,000 bill without ever sending an invoice. The only thing that changed was the yield on that 10-year Treasury.
All right, Section 3, the duration trap.
For decades, we've all been told the same thing, right? As you age, move money out of stocks and into bonds. Bonds are supposed to be the safe seatbelt in the classic 60-40 portfolio. But in 2022, that supposedly safe portfolio lost about 16%. The seatbelt didn't catch anyone. It was attached to the steering wheel of the crashing car. To understand why, you have to look at a metric called duration. You'll find it printed on every bond fund's fact sheet, right where most investors just completely ignore it. Duration is a rough estimate of how much a bond fund will lose for every 1 percentage point rise in interest rates. See, if you hold an individual bond to maturity, price drops along the way don't really matter. But a bond fund never matures. It gets repriced every single day. Understanding duration is the exact difference between taking a small financial bruise and ending up with a broken leg when rates go up.
Let's look at the real-world math on a $500,000 retirement portfolio. If your money was in a standard index fund with a duration of 6, a 1-point interest rate hike wiped out $30,000. Ouch. But if you were sitting in a long-dated treasury fund with a duration of 17, which, by the way, many believed was the safest asset on Earth. That exact same 1-point rate hike wiped out $85,000. Same retiree, same amount of money, same rate move, but a massive $55,000 difference in losses simply because of duration.
And because the Federal Reserve raised rates so incredibly fast in 2022, literally from near 0 to over 4% in just 9 months, the damage was historically unprecedented. According to an analysis by Santa Clara University, it was the worst year for long-duration U.S. bonds going all the way back to 1754. Think about that. The safe sleeve of America's retirement portfolios had its absolute worst year since before the United States of America even existed.
Let's dive into Section 4, the economy's check engine light. Beyond pricing our home loans and occasionally blowing up our retirement accounts, the bond market serves another vital purpose. It acts as an incredibly accurate diagnostic tool for the entire economy. It is quite literally the closest thing we have to a macroeconomic check engine light. One of the cleanest signals you can watch is the high yield spread. This is simply the gap between super safe government bonds and riskier corporate bonds. Because companies can go bankrupt and the government can, well, always print more money, investors demand higher yields from corporations to compensate for that risk. When this spread gets wider, it means investors are demanding a lot more compensation. The bond market is effectively bracing for corporate defaults, mispayments, and mass layoffs, long before that bad news ever shows up in the standard economic data.
We also have to look at the equity risk premium. This is the difference between what investors expect to earn in the stock market versus what they are absolutely guaranteed to earn from a risk-free 10-year treasury. Right now, that reward for taking on stock market risk is roughly 2.5 percentage points. But when bond yields rise quickly, this premium shrinks. Suddenly, stocks don't look so attractive compared to those nice, guaranteed bond yields. And this is the big aha moment. It perfectly explains why stocks and bonds both plummeted at the exact same time in 2022. Rising rates were basically poison to both asset classes simultaneously.
Which brings us to the most famous economic predictor of them all, the yield curve. If you plot the yields of U.S. Treasuries from 3 months all the way out to 30 years, you normally get a nice upward-sloping line. It just makes intuitive sense. Locking up your money for 30 years is way riskier than locking it up for 3 months, so you require a higher term premium, a higher yield for making that longer commitment.
But occasionally, this curve inverts. Short-term yields actually rise above long-term ones. When you see a 2-year treasury paying more than a 10-year treasury, the bond market is screaming trouble. It is predicting that the economy is going to slow down so much that the Fed will be forced to cut rates to save it. And it is incredibly accurate. According to the Federal Reserve Bank of San Francisco, an inverted yield curve has successfully predicted 10 of the last 10 U.S. recessions going all the way back to 1955. A perfect 10 for 10 record. You really can't ignore that.
Let's wrap up with Section 5, Beating the Bank.
Okay, let's bring this powerful knowledge right back down to your own wallet and see how you can actually use this invisible machine to your advantage. Because right now, millions of people are leaving free money on the table simply because they don't know their options. When we look at incredibly safe places to park your cash, the differences in yield are just shocking. The national average for a standard bank savings account pays a microscopic 0.38%. Meanwhile, a 3-month U.S. Treasury bill currently yields 3.71%, and the best high-yield savings accounts are sitting around 4.20%. Keep in mind, all 3 of these options offer essentially the exact same safety as money in the bank. You are just choosing where your cash sits.
Let's bring Brian back. If Brian leaves $50,000 sitting in his standard neighborhood bank savings account, he earns a measly $190 a year in interest, but if he moves that exact same $50,000 into state tax-exempt T-bills, he earns $1,855 a year. That is nearly 10 times the amount of money for the exact same level of risk. By ignoring the bond market and leaving his money in the standard bank, Brian is costing himself over $8,000 in lost interest across 5 years.
And hey, if inflation is your primary fear, if you're worried about it eating away at your cash, the U.S. Treasury offers Series I savings bonds. Right now, these are yielding 4.26%, and the beauty is that rate adjusts with inflation. There is a purchase limit of $10,000 per person per year, but for cash that absolutely needs to keep pace with the rising cost of living, I-bonds are simply the most direct and effective inflation hedge available to a regular saver today.
So we have to ask the ultimate question here. The bond market is not just a playground for the rich or some boring topic for textbooks. It is the invisible machinery touching every single dollar in your financial life.
From the rate you pay for the roof over your head, to the safety of your nest egg, to predicting the health of the very company you work for. Go check your own portfolio's fact sheets today. Find out your duration. Look at your cash yields. The people profiting off this $145 trillion machine aren't necessarily smarter than you, they just stopped pretending bonds were boring. So how much invisible money is your portfolio quietly leaving on the table?